Hello, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to this BCI podcast number 119, titled Establishing Our Cost Basis for Long-Term Holdings. We're going to be using a real-life example with Bank of America Corp, which trades on the New York Stock Exchange under the ticker symbol BAC. Now, our cost basis can be a little confusing when we do our calculations, because there are actually more than one type of calculation that we're going to be doing as we trade options. So let's get started by talking about our cost basis scenarios, specifically for covered call writing. First, we have our trade initiation cost basis. So when we're first starting our trade. And what we do is we look at the stock price at the time the trade is actually being executed. And that's for the at the money and out of the money strikes. Now, the strike price for in the money options, we deduct the intrinsic value component of the premium from the actual price of the stock. And so our cost basis when we enter an in the money covered call trade is actually the strike price, not the current market value, because we're deducting the intrinsic value component from the actual price of the stock. And the reason for that is that when we're calculating our initial time value returns, we deduct the intrinsic value from the premium. So if we're not using it in determining what our initial profit is, yet we still receive it, we then have to use it to buy down our cost basis. So if we buy a stock for $52, for example, and sell the $50 in the money call option for $3, of that $3, $2 is intrinsic value. The amount that the strike price, 50, is lower than current market value, 52. In essence, it's not profit because we're going to be losing $2 on the sale of the stock. So of that $3, $2 is then intrinsic value, leaving $1 as our actual time value initial profit. So our cost basis in that case would not be 52, but it would be 50 because we are deducting that intrinsic value component. Now, in the second scenario is how do we determine our cost basis on shares that we've owned for long periods of time, which are probably purchased at a much lower price than current market value. So we're going to break down a couple of scenarios and give you the rationale for how we do it in the BCI community. And for this, we're going to be using that real life example with BAC. So if we purchased Bank of America at $24.10, but the current price is $26.10, and the total premiums that we've collected by selling covered calls over time is $2.80 per share. Now, the last covered call was written at 80 cents. So you could see in this particular scenario that things get a little bit trickier, a little bit more complicated. So what do? Well, let's assume now that we're looking to roll that in the money strike price. Okay, if we had sold the 24 strike, the stock is currently at 26.10. We want to buy it back and roll the option. We could roll it out, or we could roll it out and up. Now, the cost to buy back that 24 short call is $2.20, right? 210 is intrinsic value. The amount that the 24 strike is lower than current market value, which is 26.10. That leaves 10 cents of time value that we're going to be spending to buy back that 24 short call. Now, if we were to roll it out to the following month's 24 call, that would generate $3. That's rolling out. So we roll out from one 24 call to the next month's 24 call. Of course, we generate $3, but it costs us $2.20 to buy back the near month call. Now, what about rolling out and up to the 27 strike? So we're rolling from the first month's 24 call out to the next month and up from 24 to the 27 strike. That generated a premium of 50 cents. So in that case, we have a credit of 50 cents, but a debit of 220. So on the option side, we have a debit, but our shares are no longer worth the required 24 contract sale price because we're closing that short call. So our shares are now worth current market value, 26.10. We're going to let the calculators do all the math for us. So here is our cost basis dilemma when we're rolling these options. Should our cost basis be, these are the possibilities now, 24.10, which was the original purchase price. How about 21.30, which is the original purchase price, 24.10, minus all the premiums we collected, 280. That would come down to 21.30. Should it be at 21.30 or the original 24.10? How about 26.10, a third choice? And that's the current market value of the stock. Should we use that when we're rolling the option? Or perhaps, is it none of the above and something different? Well, let's work this out. First, I want to tell you this. It's very important not to commingle two completely different sets of calculations. This is where a lot of retail investors get in trouble when they're calculating the cost basis for rolling the option or any other exit strategy versus looking at our overall final results when we end up closing both legs of the trade. Eventually, we're going to be closing these trades at some point. We might be rolling it next month, but we might be closing it the following. So for final results, if we were closing both legs now, our cost basis would be 21.30, right? 24.10 was the price of the stock when purchased, minus the total of all the premiums collected, 280. So for final overall results, our cost basis would then be 21.30. Now, what about for trading decisions when we're considering rolling that in the money option? So if the strike is lower than current market value, what we say to ourselves, folks, what are our shares worth prior to rolling? Well, if we had the 24 in the money strike on the table, our contract obligation, is to sell at $24. As long as that option is in place, our shares can be worth no more than $24, even though it's currently trading at 26.10. Okay, if we allowed assignment, how much would we get? $24. So when we're rolling the option, of the four choices, it's something else. It's 24 per share. Now, let's take that information and put it in to the What Now tab of the Elite and Elite Plus calculators, and we enter the information. We purchased it at 24.10, currently trading at 26.10. Those of you also watching this podcast, we're entering that information into the blue cells of the What Now tab. We originally generated 80 cents on the last option trade. The cost to buy it back, $2.20. Now, if we rolled out to that same 24 strike a month later, we generate $3. If we roll out and up to the higher 27 strike, we generate 50 cents. So that information is entered into the blue cells of the What Now tab of the BCI calculators, and lo and behold, on the right side of the spreadsheet, the results will appear. And here's what we learned. Rolling out results in a 3.33% initial time value return. But since we rolled out an in-the-money strike, we also have downside protection of that initial profit, which in this case is 8%. What that means, ladies and gentlemen, is that we are guaranteed a 3.33% time value return as long as share value does not decline by more than 8% by contract expiration. So that looks like a pretty favorable trade for most of us. Now, what if we're very bullish on the market? What if the chart technicals were all bullish and confirming, and we wanted to take a little more aggressive approach to exit strategies and rolling our option? Not out, but out and up. So what that tells us, if we roll out and up to that 27 strike, that yes, we are actually losing money on the option side, $170 per contract for that matter. But because the value of our shares are worth more once we remove that $24 contract obligation to sell, and we factor that unrealized share appreciation into our calculations, the final results are as follows. Our actual initial return is 1.67%, but with the additional upside potential of our shares moving up to that 27 strike, there's a potential for a total 5.42% 1 month return if BAC moves up to that higher 27 strike by contract expiration. So we would roll out to get a very substantial 3.33% time value 1 month return with that 8% downside protection, or a more aggressive approach would be to roll out and up to get that potential 5.42% 1 month return if we anticipated share appreciation. Let's summarize. It's very important not to commingle two completely different sets of calculations when making our trading decisions. Our current trades should be based on current statistics, while longer-term trade evaluation based on a series of trades will be based on longer-term data, as we showed in those two examples. So it's, again, there are two sets of calculations regarding cost basis, and we must identify which one we're using, the long-term total trade results, or are we looking to find our cost basis for performing exit strategies during a series of trades. Ladies and gentlemen, as I always do during these podcasts, I want to bring to your attention the BCI package, our best and most comprehensive investment package ever produced by the blue-collar investor. You get 6 online video courses with downloadable workbooks, 6 calculators developed by and found nowhere else, the blue-collar investor, and 5 of our best-selling books in ebook format, including the #1 best-selling books on both covered call writing and selling cash secured puts. Our 13-month premium membership, which includes 4 reports of eligible securities for options trading, along with our online continuous training videos, expanded calculators, and much more. And as far as our training videos are concerned, we have the entire library of Ask Alan videos, along with our Blue Hour webinar series, more detailed, in-depth presentations. And we add 1 additional training video each month, some months 2. The time of this production, we've had over 200 training videos. And again, we add 1 each month. Go to our website, www.thebluecollarinvestor.com. Click on the link that says BCI Package, and there'll be more information, including a video describing all the benefits and perks for our BCI package, which is discounted 25% from purchasing all these items individually. Folks, I want to thank you very, very much for taking the time to listen and or watch this BCI podcast number 119, Establishing Our Cost Basis for Long-Term Holdings. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.